Welcome, everyone, and happy Thursday afternoon for those on the East Coast. Welcome to ALU Gamma's webinar, The Stimulus, How Does It Work for Financial Advisors? Hope everyone is staying safe and healthy. My name is Josh Karen. I'm the AVP of Political Affairs for ALU. Thanks again for joining us. Over the next 60 minutes, we're going to go ahead and guide you through the most recent information concerning the CARES Act, a quick preview of what is to come next legislatively, then bring you up to speed on some updated guidance recently released from Treasury for financial advisors who may be independent contractors, W-2 statutory employees, or self-employed. So a lot of good new information for us to cover today. We're also going to cover in detail the SBA resources that are currently available, the Paycheck Protection Program, the Economic Injury Disaster Loans, and with some specific examples to help your clients and yourself when you're trying to access some of these funds. We're also going to try to answer as many questions as we can over the course of the next hour. As you can imagine, we are going to get more than we can possibly hope to cover in a short amount of time. So please keep coming, or please keep sending them in. A couple of quick housekeeping items before we start to dive in on the substance. First, for recording of this webinar and its slides, all of our preceding webinars, as well as the other written materials that we've produced so far, please head to the COVID-19 Action Center on either alu.org or gammaweb.com. This information is moving really, really quickly. As we were producing the slides and the content for today, we had a number of pretty late breaking and important changes. So the information is moving really, really quickly. And as much as we try to stay current, some of the information that we produced a couple of weeks back might be not as relevant as today. So please continue to go to the website. That's where you're going to find the most current information. Second, and I kind of already hit on this, we do want your questions and your feedback, not only today, but throughout this process. On the webinar today, there is a Q&A function at the bottom of your screen. Please go ahead and utilize that to send questions directly to the panelists. We will do our best to cover them. Again, we're going to get more questions in the next hour than we can possibly hope to answer and to get to. So if we don't get to your question today, we will do our best to find you the answers. And then thirdly, before we go ahead and get started, I want to take a quick moment to invite you to answer a couple of polling questions that will be coming up on your screen. These questions will help just kind of guide the conversation as we go through the next hour. So let me pause for a minute and give you guys a chance to go ahead and click through these questions really quickly. All right, thanks. Look like we've gotten some of our answers. Thank you very much for taking a minute to run through that. This will definitely help us kind of steer the content for the next hour. So I kind of jumped ahead really quick, but let me go ahead and introduce my fellow panelists that are going to be joining us. Hopefully you've been on a few of these webinars before, so these are starting to become very familiar faces for you. First, we are joined by Armstrong Robinson. He's the Vice President of Legislative Affairs here at ALU Gamma. He is a former chief of staff for a number of members up on the Hill and a really good tax mind. He's been producing these webinars at a clip that makes me wonder if he has time to do anything else in his life, but he's doing a fantastic job on them. We also do have Ken Keys. He's the managing director of the Federal Policy Group as an outside tax counsel to ALU. He's a former chief of staff to the Joint Committee on Taxation and has been a lot of times joining up with Army to roll through this information. So we really appreciate both their time and their expertise as we go through everything today. So from here, let's go ahead and start to jump into a real quick overview of kind of where we find ourselves in terms of the legislation that has been passed so far. The pandemic has really upset every aspect of American life. We've seen that in our daily lives, in our businesses. Since early March, a lot of folks have been under stay-at-home orders, and the economic activity has correspondingly really started to slow and grind to a halt. So while at this point the economic pain that has been inflicted by the pandemic is not yet fully known, what's easily observable is that it is going to be significant. So Congress and the administration, they moved quickly to try to inject some money to try to mitigate some of the worst economic effects, with 3 separate legislative packages so far and a number of aggressive moves by the Fed. The first package was passed into law on March 6th. It added billions of dollars for increased testing capacity and to help for some key federal agencies who are going to be mobilizing to address the pandemic. The second package was passed into law towards the end of March and added over $100 billion in funding for more testing, paid sick leave, more funds for Medicare and SNAP, and increased unemployment insurance benefits. And then the last package, which is known as the CARES Act, and it's where we're going to spend the majority of our time today, that was a $2.2 trillion package, significantly dwarfed any of the stimulus packages that were passed back in 2008 during the Great Recession. The package, and we'll go through this in much more depth and detail, but the package consisted primarily of funds for individuals and families, small businesses, and a number of the other priorities. We've been kind of referring to them, and a lot of people have been referring to them as stimulus. A better way to kind of think about them really, though, is they are trying to get Americans through this extended period of not working, ideally by remaining on the payroll of their employers, trying to help as many people get from point A to point B when the economy can reopen and start growing. There's going to need to be actual stimulus that is going to come later on this year. So a real quick overview of where we stand currently on some of these programs. As I can move my slide over here. Hold on. There we go. So where do we find ourselves today? So at the moment, we've seen on the recovery rebate side, we've begun to see some of that money be dispersed. The Treasury Department has so far said that 80 million Americans have received funds in a little less than 3 weeks, which is a pretty sizable achievement on the Treasury side. All is not well, though. We've seen some reports begin to pop up this morning about some Americans who were expecting their rebates today, either not getting them or getting them in incorrect amounts. The Treasury Department is working diligently on correcting some of those mistakes. And that number of 80 million people who have received rebates so far are currently on track to, doesn't take into account the folks who are unbanked, the folks that might have access to direct deposit. And so getting funds to those Americans is going to take a little bit longer. On the small business side, we've seen an overwhelming demand for some of the relief packages that were offered in CARES. The 2 main programs that we're going to talk about today, the PPP and the EIDL loans, they were both funded originally with $350 billion in the CARES Act. So starting with the PPP, the SBA reported this morning that there has been 1.6 million applications, and that funding for that program has been depleted. And so they're going to need to go ahead and add some money back into the PPP program. The EIDL loans that were offered through the SBA are in a similar position. The initial funding that was set aside for them has been quickly exhausted. So both programs have been trying to work at a breakneck pace to try to get as much relief into the economy and into the hands of individuals and businesses as possible and as quickly as possible per Congress's design, really. But there has been confusion by some about who qualifies, how to apply, and some reported delays in the disbursement, although we've heard a lot from our membership that a lot of those funds are moving really, really quickly now. So a preview sort of what's to come next when we talk about legislatively. So clearly, goes without saying that the demand for what Congress originally funded has been exceeded, and so we need to go ahead and add more potential money into these programs. Congress has been working on this for the last week, trying to add more funds and agreeing on a package that will do so. Last week, Majority Leader Mitch McConnell moved to try to pass a bill in the Senate that would have added $250 billion in extra funding. That was blocked by Senate Democrats, who were seeking not only the extra funds, but also some more funds for extra testing capacity, PPE, hospitals, states and cities who are being affected by the crisis. So they're trying to work out what that package will ultimately look like. Currently, the negotiations are really centering around Secretary Mnuchin, who's been taking the lead on behalf of the administration, and also Speaker Pelosi and Leader Schumer, to try to figure out what's the deal that's acceptable for all parties. So with that brief overview, let me turn it to Ken and Army. Why don't we start with Army first, who can give us their insights into how this impasse might get resolved, and once we get past an agreement around this round of relief, what the next round might look like.
Thanks, Josh. Good afternoon, everybody. And thanks again to Ken for joining us for another edition of our webinar series. We've already seen a lot of questions. There's a lot of concern about people who haven't gotten their loans yet and whether funds will be available. So this is right in the heart of what you're talking about, Josh. I fundamentally believe that Congress will pour more money into both the PPP and the EIDL buckets. It's a question of when, not if. So I think your applications are still valid. And while the SBA, somewhat to my surprise, announced they wouldn't be processing new applications until Congress appropriated more funds, this is still a very valuable webinar for you because, as I said, I think Congress will approve more funds. And once they do, they will take more applications, and this will be a program available to you. Excuse me. Right now, Congress is scheduled to reconvene May 4th, which is about 12, 14 days from now. It is possible the House and Senate have pro forma sessions that could unleash more funding if they develop an agreement before then and they're able to keep all the members pointed in the right direction. And so it is possible that it will happen before May 4th, but otherwise I believe it'll come that week. The partisanship in Washington, which leaves so many Americans with less respect and admiration for our political leaders, which is understandable, tends to wax and wane with the level of crisis that they're under. And given that now 1 in 10 Americans is lost their job in the last month, and the remaining small businesses, many of whom you are on the phone represent or are working with, are without additional resources at this point. I mean, the temperature is about to go through the roof around getting something done, and I believe that will ultimately break the impasse. Ken, what are you hearing from the Hill?
So I guess I would just add a little bit to this, that we live under the uncertainty of really not necessarily knowing when the Congress will come back. McConnell and Schumer announced they would come back on May 4th. However, the mayor of the District of Columbia just a day or so ago said that she does not expect the coronavirus to peak until the end of May. And as we get closer to that May 4th return date, I think the congressional leaders are going to have to be somewhat careful about whether it makes sense to bring a bunch of people back into Washington when we're still on the upswing in terms of the number of coronavirus infections that are occurring. I agree with Army that somehow they're going to have to figure out a way to reload the bucket for the PPP loans, but the path forward is not 100% clear, but it's just got to get done. So the good thing is the negotiations, what we are hearing is Mnuchin is having a very active discussion with Schumer and Pelosi, and since nobody apparently is concerned about the fiscal impact of this, this is really just all about negotiating numbers. So there ought to be a path forward here, and hopefully it'll happen sooner rather than later. So back to you, Army.
Yeah, thanks, guys. And so I think, that's kind of the current state of play as we see it. Again, this is moving really fastly, so I would not be very surprised to see, some movement over the next hours and days here. So let's kind of look now for what was in the original CARES package, and we can talk for, we're going to take this in a couple of different chunks. We're going to kind of roll through first What is some of the relief that is available for financial advisors today? We'll talk about some that's a little bit more focused on the individual side and a little bit more towards the business side for you guys. So let me kind of start with what's on the screen here with the recovery rebates. So like we talked about a little bit before, we've seen some of this money start to be dispersed out to individual Americans. Everybody can expect either $1,200 or $2,400, depending on single or married filing jointly, up until certain thresholds. Once you get above those adjusted gross income thresholds, there is a phase out of some of that money until you hit a certain cap in which individuals will not receive any of those funds. There's also an ability for any child below the age of 17 for a $500 recovery rebate to their parents for them. So that's on the recovery rebate side of that. And unemployment insurance, we've seen $600 in federal money that is available above and beyond state relief for up to 39 weeks. And that money is available for independent contractors as well. We've also seen some changes around retirement plans. The withdrawal penalty of 10% has been waived for accessing qualified plan monies for COVID-19 related expenses. You can pay that back over the course of 3 years. Obviously, that's a conversation to have with a financial advisor about whether or not that is the right strategy for you, if there are other ways to be able to create liquidity outside of that, but that is a potential path for folks. We've also seen some movement around student loan and mortgage relief. Federal student loan payments at the moment have been suspended throughout the end of the year. As in the CARES Act, so that's been another piece for individuals. There was also some changes in the charitable giving exemptions. Tax Cuts and Jobs Act reduced kind of the tax incentive to give to charity with the doubling of the standard deduction. That just took a lot of the folks out who may have otherwise itemized. The CARES Act is put in a $300 non-itemized tax credit so that folks can give to charity above and beyond. It is automatically applied to your 2020 tax return, and you don't have to be itemizing your returns to be able to receive that. And then there's delayed IRS deadlines, which I'm sure everybody has seen, the ability to file your tax return until July 15th. It doesn't mean you have to wait that long. Feel free to file now if you want to get your return. But you do have the ability to delay when you will file if you want to. And so those are some of the big individual components of the CARES Act. Obviously, one of the other big one in here is the ability for independent contractors to be eligible for the SBA programs. So with that, let me go ahead and turn it to Army, who can start to walk you through some of those aspects.
Hey, Josh, it's Ken. Can I just highlight one development from last Thursday, which is kind of a big deal, and that is the IRS in providing further relief as to when certain returns and payments have to be made, expanded it so that it also has delayed estimated tax payments that are due June 15th until July 15th. They had already delayed estimated tax payments that were due April 15th, but they expanded that to estimated tax payments due on June 15th. So that was a pretty significant change. So just one little piece there. Go ahead, Army.
Thank you, Ken.
Sorry.
That's very helpful.
Yeah, thanks, Ken. Thanks, Josh. As you can see, our focus today will be on the small business programs. Just to reiterate, we do believe those will absolutely be replenished. It's a question of when, not if, but I think it's a matter of weeks that we're looking at. So this is, from my perspective, still very valuable for you and for your potential clients. The entire CARES Act, which Josh described really well, is designed to provide, what is effectively a variety of liquidity-oriented bridge loans to the American people. That's why, for the first time, the CARES Act expanded the eligibility for Small Business Administration resources to independent contractors, self-employed individuals, gig economy workers, and the like. The three big pieces within the SBA out of CARES were small business loan relief. I'm not sure that that's more of a client thing probably for the people on the webinar today. Somebody who had an existing small business loan could get 6 months of principal, interest, and fees paid by the government. Just that's similar to what Josh was talking about in terms of federally backed mortgages and student loans in terms of um, just cash flow by deferring obligations. The two big pieces, of course, as Josh described and we've talked about a couple times, are the Paycheck Protection Program and the Economic Injury Disaster Loan Program. The EIDL is not new, although it has been expanded significantly for our response to COVID-19. And as you see here on the slide, a small business may receive both loans. However, the funds ultimately must be used for different purposes. And this is, again, right where we are today in our audience. Independent contractors, self-employed individuals, and statutory W-2 independent contractors are eligible to participate in SBA programs under the CARES Act. There we go. So how does it work for you? Your loan is based on your net income last year. If you have employees, you've got an assistant or an aide or somebody who is a common law employee, you can count their compensation in your base calculation. Up to 8 weeks of pay and expenses is forgivable, effectively making it a grant. There's no federal income tax owed on the forgiven amount. It's part of why this is so generous and so attractive. And any amount that isn't forgiven stays under the loan terms, which are the first payment due 6 months after the loan originates. You can request a deferral of that first payment up to 12 months. It's a 1% interest rate, and the current payment term is 2 years. You apply, as I think most people by now know, through a private lender. This is the infrastructure on which this program is built is what's known as the SBA 7A program, which is a partnership between private lenders and the federal government. We have heard, and I know there's a bunch of questions on this already, so I'll go ahead and address it. We have heard that, because it's a federal private partnership, each bank has had its own variation on the application process, and some we have heard are requiring business accounts with their financial institutions as opposed to personal accounts. We're continuing to look into that, and as the incidence rate goes up, we'll look at different solutions. The only solutions we can tell you about thus far from the marketplace involve lender shopping. You have to sort of find another bank that's willing to process your loan, and that's probably a little bit of time away while we wait for Congress to replenish the funds here. And the SBA.gov as well as the COVID Action Center have lists of the top 100 7A lenders and lender matching tools. So that's available there. So here's where there's a lot of confusion, and we're going to go through a bunch of examples that Ken has helped us create. But there are two distinct and important calculations that often get confused in what you hear on the internet about this program. The first is your maximum loan amount. It is the average monthly payroll expenses from the last year multiplied by 2.5. It's effectively a look back rule, right? So it looks at what you were paying, or in this case, what you were earning. So in the case of an independent contractor or statutory W-2, you can include net earnings up to the $100,000 cap. If you employ other people as common law employees, you've got an assistant or somebody who works with you and you pay their salary, you can add them to your base calculation. And we'll go through a couple examples that'll make this clear. It's a quick note, there's one distinction for your employees. The non-cash compensation that you pay for their group health benefits or retirement contributions is a potential plus up on their base calculation number. It isn't, that privilege isn't afforded to owners or the self-employed. So you can't add what you pay for your health benefits to your calculation. You just get the $100,000 up to $100,000 base. Well, in terms of making the business decision, of course, about whether this is the right avenue for you to pursue, you have to know sort of what the maximum forgiveness is potentially. And we state this as a maximum forgiveness example because we're going to tell you what it could be. What it ultimately is dependent on what bills you pay in the 8-week period after your loan originates. So this is a look forward rule, right? So it depends. So it begins, the 8-week period begins on the day you first get funds out of the PPP program from your bank. 75% or more must be for payroll or earnings. It's what you pay yourself, and Ken will talk more about that in the IC context in a few minutes. And eligible costs include those payroll costs that were in the base calculation for the maximum loan, interest on covered mortgage obligations, rent, leases, that kind of thing, and covered utilities. Again, the whole idea and structure behind this program is to keep your business idling across the shutdown of the economy and prime you to be able to roar back when the economy reopens. The process, again, like backing up another step, is you apply for the loan. You're ultimately, when you're approved for the loan, you'll get a disbursement of funds. Only once you've gotten the funds can you, 8 weeks later, apply for forgiveness. And so that's sort of the basic broad-based steps. So the following examples are based on our reading of the rules as we know them today. New guidance has been released almost daily. This is a $350 billion program built on an infrastructure that last year in 12 months gave away or lent out $23 billion. And they've successfully, by the reports we all have in the press today, pushed out $350 billion in less than 2 weeks. All the days have run together. But I think it's two-week anniversary of the first application will be tomorrow at 12:01 a.m. That's sort of illustrative of their intent. And I anticipate that they will move even faster once Congress replenishes the bucket to push money out again. And we will, of course, keep you very well informed and closely attuned to when that's going to occur. You just need to stay tuned to our emails and the COVID-19 Action Center. So Ken, let's turn to you and go through some of these examples, if you would.
Okay, thanks, Termy. So we start with example 1. There he is. And we're kind of starting with a base case here, and we'll build on it as we move from one example to the next. So our base case is a business owner who is a sole proprietor, self-employed, or independent contractor, no employees, net income for 2019 of $105,000. And basically, you look to line 31 of the Schedule C for 2019. Covered rent, lease equipment, and other utilities are $600 per week. So the payroll cost number here for this sole proprietor is subject to the $100,000 cap. So in determining the maximum loan amount, you can see that the calculation is you take $100,000, divide it by 12 to determine the average monthly compensation over the prior, during 2019. You multiply that by 2.5. That tells you the maximum loan amount for this individual is $20,833. The maximum forgiveness, which again is the look forward calculation, is the $100,000 of payroll. You divide it by 52 to get the average weekly amount, multiply it by 8 because it's an 8-week forgiveness period. And you also add those expenses for 8 weeks, and that produces a maximum loan forgiveness of $20,184. So the remaining loan amount of $648 is all that's left of the loan after the forgiveness occurs. So why don't we go to example 2? So here we go. Who's in charge? Let's look at example 2. Okay, there we go. Okay, so example 2 introduces a couple new concepts, and one of which was a recent development, and it just highlights the point that Army made at the outset of looking at these examples, which is we're literally getting guidance almost daily, either in the form of FAQs, frequently asked questions, or in the form of interim rulemaking that teach us things that we didn't necessarily think we saw there. So this example it will flesh out one of those points, and it's kind of an important one. So in this particular case, we have a business owner who's a sole proprietor, one employee making $40,000 a year with non-cash benefits of $5,000. The net income of the sole proprietor is $105,000. So for purposes of determining the payroll costs, we include the business owner's amount subject to a $100,000 cap, plus the employee's total comp, both the cash and non-cash piece. And that's where we got a revelation through one of the FAQs or the interim rule, which was a pleasant surprise, and that was the ability to count non-cash even if it exceeds the 100,000 of the employee. But in this case, it doesn't, because it's an employee making 40,000. So we look to our maximum loan amount. We include payroll costs, so it's 100,000 for the self-employed person, the 40,000 of cash paid to the employee, the 5,000 of non-cash benefits, which would include things like health insurance premiums, 401k contributions. That gives us a base of 145,000 divided by 12 to multiply it by 2.5 to get our maximum loan amount. And then we calculate our maximum forgiveness, again, on a look forward basis. So we take that 145,000 base, divided by 52 to get the average weekly expense, multiply it by 8, which is the 8-week period of forgiveness. And we also add to that 8 times 600, which is 600 is the weekly expenses that are permissible, which tells us the maximum loan amount is 27,107. The remaining loan amount is 3,104. Now we have a note on this chart that points out that if the employee were an independent contractor, not a common law employee, then none of the compensation of that person, that independent contractor, would be includable for purposes of determining the owner's payroll costs, and therefore the maximum loan amount and the maximum forgiveness. So it's crucial that in order to include the compensation of that person, that it be an employee, a common law employee. Okay, let's go to example number 3, because this raises an issue that we have gotten a lot of questions about. We have a statutory employee for Carrier A who is not a common law employee. So they are a statutory employee, which means they are subject to the FICA tax, but otherwise treated as an independent contractor, sole proprietor. So they file a Schedule C. They're entitled to take business deductions under Section 162 of the Internal Revenue Code. In this particular case, the carrier paid $65,000 to this statutory employee. The statutory employee also made income from investment advice, and the total net income of the statutory employee was $115,000 and had expenses of $600 per week. So for this particular person, it's the statutory employee who's filing for the PPP loan. And what this example flushes out is how that person would calculate their maximum loan amount, and it shows us their maximum payroll would be subject to the $100,000 cap. So that would tell us the maximum loan amount based on our formula of 2.5 times the average monthly amount of compensation would be $20,833. And for purposes of calculating the maximum forgiveness, the employee would, this statutory employee would get to obviously include 6 weeks of expenses, or 8 weeks of expenses, to produce a maximum loan forgiveness of $20,184. We have another note on this slide which says, similar to example 2, our prior example, if this person had an employee, these amounts would be includable in the base calculation. But let me also highlight one other thing that's not specifically mentioned on this slide, but it's consistent with what we've already said, and that is this statutory employee does not get to include the non-cash payroll type expenses that were applicable for he or she. In other words, they're capped at $100,000, even though they might be paying health insurance premiums or making contributions to a retirement plan. They don't get to count those. Those are only counted if it's a person who's an employee. All right, well, why don't we go to example 4? Here, there we go. Let's go back to example 4. Okay, there we go. Example 4, an LLC, no employees, active owners who each own 50% of the entity. So how do we go about calculating how they are treated. Again, this was an interesting development, which we've got some clarification on, which is that the LLC would make the loan application. This was fleshed out in either an FAQ or an interim rule release just in the last couple of days here. Previously, we had thought, based on the statute, that each owner would have made their own application. But basically, the guidance that came from Treasury said, in effect, this is a lot simpler way to do it. We'll have less loan applications, so this is the way we're telling you to do it. So in other words, it's the LLC that makes the loan application. So we look at each of the two owners. They're each making $150,000. So we cap the total of their payroll costs at the $100,000 amount. So that tells us when we go to calculate the maximum loan amount, the base is $200,000, 2 times 100,000. We determine the monthly average of 12 and divide it by 12 and multiply it by 2.5. So this LLC would be entitled to a maximum loan of $41,666. The maximum loan forgiveness follows the similar calculation we've shown in the past. So we take the $200,000, determine the average weekly amount, multiply it by 8 weeks, and add to that 8 weeks of the $1,000 per week of expenses, which tells us the maximum loan forgiveness would be $38,769 with a remaining loan amount of $2,897. So let's go to example 5. Okay, example 5. It just sort of adds another element to the picture, which is this LLC that we had looked at in example 4. Also, this LLC has a employee compensation of $40,000, non-cash compensation of $5,000, the same amount of income for the two 50% owners. So when we go to calculate the maximum loan amount, not only do we get to count $200,000 of the active owner's income subject to the $100,000 cap, but we get to add $45,000, which is the amount attributable to the employee, including the cash and non-cash compensation of the employee. So that boosts the maximum loan amount from our prior example up to $51,000. And it, as you show, our maximum forgiveness is also higher, up at $45,000 with a remaining loan amount of $5,349. Okay, let's go to example 6. So in the case of example 6, we have an S Corp. And this is an area where there's been some confusion. And the recent guidance we got told us that partnerships apply at the partnership level. They didn't specifically address S Corps, but our best judgment is, given what they have determined with respect to partnerships, that they're probably going to take the same position with respect to S Corps applying for the PPP loans. We had previously thought, as we thought in the case of partnerships, that each S Corporation shareholder or owner would be applying on their own. Our best judgment, based on the rule that they have articulated for partnerships, is that they'll follow the same rule. And therefore, when we look at this example, an S Corporation, no employees, 250% owners, they pay comp to each of the owners of $100,000. There's $50,000 of residual profit allocated, $25,000 to each owner, and $1,000 per week of expenses. Our best judgment is that the payroll cost here would be the reasonable comp paid of $100,000, and that would be capped, and therefore the maximum loan amount and the maximum loan forgiveness would be based upon that $200,000 of payroll. So the maximum loan amount would be $41,666. The maximum forgiveness $38,769. We go to example 7. It just adds a little bit more of a variation on what was in example 6 because it adds the fact that there are 2 employees. They make $40,000 and $60,000 each. There's 2 independent contractors working for this S corporation who make $75,000 each. And then we've got the 2 owners who are each being paid reasonable comp of $100,000 per person. When we go to calculate our maximum loan amount, we start with the $200,000 paid to each of the owners, the total $200,000 paid to the 2 owners. We get to add to that the amount paid to the 2 employees who make 40 and 60, which brings us up to $300,000. Based upon our earlier examples, we don't get to include anything paid to the independent contractors because that is not permissible in terms of calculating the payroll amount. Independent contractors have to apply for their own PPP loan. So when we look to the calculation of our maximum loan amount, the base payroll base 300,000 divided by 12 times 2.5 tells us our maximum loan amount is $62,500. And in calculating our maximum forgiveness, we use the same formula and add to it the 8 weeks of $1,000 of expenses, which produces a maximum forgiveness of $54,153. So the remaining loan amount is $8,346. So that, Army, completes the review of the examples that we've got for today.
Thank you, Ken. That was incredibly helpful and covered a lot of ground. We got a lot of questions over the course of that. So why don't we go ahead and start kind of running through some of those and giving some folks some guidance where we can. The first kind of 2 that I think we should tackle in a bucket revolve around tax returns. So one, for the recovery rebates, if you had a child in 2019, that wouldn't be reflected on your 2018 tax return. But if you have yet to file your tax return for this year, how would you go about claiming the recovery rebate for your child?
So is it a child? I assume it's a child that is under the 17 age amount, correct?
Correct. They were just born. Yep.
I didn't. Okay, now I get it. So that is an excellent question because the IRS is generally firing out these rebates based upon the information on the 2018 return. And in this example, it's the child doesn't appear on the 2019 return. Is that the facts, Josh?
Correct. Yes.
You know what? We're going to have to get back to them on that. I'm guessing they're going to have to specifically. I believe the IRS has like a portal or something for people to basically go to and say, "Hey, I didn't get the count." But I would suggest between you and I and Army that we get to the bottom of that and put it on our website so people will know.
Thanks, Ken. Josh, maybe we should go back to the first 2 examples and talk through some of the questions there, because I think that might be useful. I know we've got a bunch of requests around that.
Yeah, of course. So just flip back to here. So we had a lot of folks who were asking questions around, excuse me, as a go ahead one, who were asking questions around, as a sole proprietor with no employees, what if their Schedule C was a loss for the year prior? Would that affect their ability to receive relief through this?
The answer is, I think, yes. Because all these calculations are based on the payroll, essentially having payroll, and conceptually the way in which the Treasury is administering this thing is they're saying when you have a self-employed person, their payroll, in quotes, is what income they made. And so if they had no net income, I think the answer is that they're not entitled to any loan here. Again, we'll try and confirm that it's absolutely correct, but I'm pretty sure that's the answer. Army, do you have any other different thought on that?
Sorry, I was typing out an answer in our Q&A while you were doing that. What was the question, Josh? Give it to me one more time.
Well, very quickly, it's somebody who, for 2019, their Schedule C was a negative number. They had no net income. Are they entitled to a loan? And I think the answer is no. If you had no net income for 2019, and 2019 is the base period to look at for purposes of determining payroll when you're dealing with sole proprietors, self-employed, or independent contractors. So I'm pretty sure that's the answer, but we'll also get that.
Yeah, that's one of those unique questions we haven't gotten yet that we'll have to dig around. There was another question related to that, Ken, that I don't know if you can comment on, is why they base it, do you know why they base it on net income versus gross income?
Yeah, pretty much. I mean, they're trying to first off, they had to think hard about how do I figure out what is the payroll to a person who's self-employed, because it's kind of like putting a square peg in a round hole. And they came up with the concept of we'll basically say your payroll is what you made, and if they use the gross amount, it would overstate what was kind of their net income. And since you're getting to count some of your expenses, if you got to use the gross amount, it might look like you're double counting. So, I mean, I can understand why they came to the conclusion that net was the right number. I'm not saying they couldn't have come to a different conclusion, but it's not illogical to me. It makes sense given what they were trying to accomplish, which was get a number for self-employed, sole proprietors, independent contractors that is related or similar to the payroll or the compensation paid to employees. So that probably isn't 100% clear, but that's sort of my best judgment.
Thanks, Ken. For an independent contractor with no employees, assuming they got the max loan of a little over $20,000, if during the 8-week period the independent contractor makes a contribution to their SEP IRA, would that count as a payroll expense, and could part of that be forgiven?
I think the answer is no, because, well, so let's assume that this person has comp of over 100,000. Well, we know that if you're self-employed, sole proprietor, independent contractor, you don't get to even count non-cash forms of compensation in determining your payroll. You don't get to count them at all. But if you're over 100,000, then that contribution wouldn't have any impact on the maximum forgiveness calculation. And it's the maximum forgiveness calculation that is looking forward at what you do in the 8 weeks. But well, so Ken, I think the answer is,
yeah, I think that's right. We haven't seen for the audience, we haven't seen a Treasury FAQ on this one yet, but they have answered the point. The employer or owner or sole proprietor can't count the non-cash on the way in. You can only count that for employees. And so logic would suggest that you can't count it on the way out either, on the forgiveness part either. But we'd have to, yeah.
I'm pretty sure, but I'm pretty sure that's right. I will just add one other little note here. We haven't talked about this, but there is a concept in determining your maximum forgiveness amount, if you do have employees, that you in effect in the 8-week period have to keep employing them. And if you don't, there's a clawback of how much forgiveness you're entitled to. In other words, part of that forgiveness would get reduced if you laid off people during the 8-week period. So far, the Treasury has provided very little guidance through FAQs or this interim rulemaking on this particular topic, and that makes sense because that's a problem for down the road here. But just based on what the Treasury is generally doing, I would fully expect we're going to get some guidance in maybe a couple weeks from now on how the clawback works, just so people can be aware of what they need to be doing during the 8-week period if they want to maximize the loan forgiveness.
Thanks,
okay, Josh, back to you.
We've got this question in a number of different forms, so I'm going to just put it in general terms rather than some of the specifics that have been offered. If you are both a statutory employee and an LLC or have multiple businesses, can you file a PPP for both?
The answer is almost certainly not if you're going to exceed the 100,000. And I assume that's would be the fact pattern people have in mind.
I think, Ken, doesn't this go to the affiliation rules? Like it's you are a financial advisor, and so you're a statutory W-2 with an insurance carrier, and you're getting income there in the statutory W-2 and the 1099, but then you may also have invested in a building that rents office space. Isn't that kind of what's going on?
Well, yeah, I mean, but I think if you were a statutory employee only making 50,000, and you were also a member of an LLC and you made 50,000 there, I'm guessing what they would do is allow you to calculate a loan based on $100,000 total.
Right.
But certainly I can't believe what they would do is let you do $200,000 loans.
Right, and it's likely one application. The other question we've gotten, which is a slightly less clear example, is, I have my personal business with one of the carriers, and that's how I get my statutory W-2 and 1099. But then I'm an investor a co-owner of the building with Josh and Ken, and so there's differential elements of control. So it wouldn't then necessarily be clear I'd apply, or how that combination works. I don't think we've gotten a clear answer on that yet, have we, Ken?
No, but if the facts are that the individual, did you say they were a statutory employee? I think you did.
Yeah, they're a statutory employee in their day job, but they also, like I am, and then I co-own a building with you and Josh as an LLC.
Okay. So again, I think the answer is if you're making 100,000 as a statutory employee, you're not going to be able to file for a second loan based on your real estate business. I just think that's highly unlikely.
Thanks, guys. We've gotten this question a lot. Army, why don't I give it to you? What happens if you have not yet filed your 2019 tax returns? Do you have to use your 2018s? Are there other avenues to show income?
So what the guidance on Tuesday said about this, Josh, is that you have to go ahead and prepare your 2019 Schedule C and submit that as part of your application, even if it hasn't yet been filed. But it is based on the 2019 Schedule C, even if it hasn't been filed and processed. So that Treasury said that on Tuesday.
Great. Thank you, guys.
Let me jump in with one, Josh. Ken, do you know, or have you looked at in the Treasury guidance, a bunch of people have asked, if I'm a IC, sole proprietor, statutory W-2, and I get this loan, how do I prove what I paid myself in the 8-week window? Do you have anything on that?
That's a good question. I don't think anything we've seen addresses that unless I missed it. And it kind of goes to the point I made just a moment ago, which is they haven't given us any guidance on the clawback issue, which is relevant to this question, because if you were counting employees and then you didn't pay them during the 8-week period, you'd be subject to a clawback. That they're going to have to give us some kind of answer on that, but I don't know how they're going to do it. That's a really good question.
Yeah. So here's what here's what my counsel would be to you is, and speaking to the audience now, like every other loan you've ever signed, from a card or a mortgage to this SBA process, when you finalize the loan docs, there's going to be a bunch of guidance that comes with it. We three, Josh and Ken and I, haven't seen a copy of that yet. And so that I anticipate will have some guidance around this point. And as Ken says, the Treasury will be coming up with information about the forgiveness and the clawback and the documentation. Remember though, that even if Josh were approved for his PPP loan today and received money on Monday, that would begin his 8-week period, and he wouldn't apply for forgiveness until probably near the end of that 8 weeks or afterwards. And so there, while the application process around all these loans has been phenomenally streamlined, whatever process you do about accounting for how you spend this money should be very detailed. We've had the question on other webinars, do I need a separate account? I don't know or believe that that is required, but you should document all payments that you make with this money very clearly for any potential audit or clawback on the back end.
Yeah, Army, I think that is a good segue into a next sort of set of questions. I've had a lot of questions about the EIDL loans as well. And yes, as you do have the ability to apply for both, although as Army said, you need to use them for separate and distinct expenses. So I had one question earlier in terms of, I had a number of financial advisors who applied for an EIDL loan, did not receive any money in the 3-day initial time period, have still not had an update on where the status of their funds might be. Can you guys kind of talk a little bit about the status of the EIDL program as it stands right now, and what might be the process? Are they going to make people reapply? Will applications that have already been submitted still count? What's your guys' thinking around the EIDL loans at the moment?
So here's a couple clarifications. The SBA clarified a couple weeks ago that the 3-day window for the advance or grant comes after you've talked to an SBA loan officer. So if all you've done is apply, that doesn't start your 3-day clock. Your 3-day clock starts when you talk to someone. The government, there's been obviously a lot less focus at the national level around the EIDL program. It was funded at a much lower level, but there's clearly chart-setting demand around it. We heard from one Senate staffer late last week that they were running low on funds in the EIDL, but at the same time, there was a new requirement that popped up in the EIDL application processing on Tuesday, where they were trying to prorate the grant based on the number of employees you had. And I saw that only because one of our AALU Gamma members forwarded me the email they got, and that's what it said. It said that was a new calibration. I believe that loan applications that are already in will count, and you won't have to reapply. As Ken said earlier, and maybe Josh did as well, a big part of the government's focus here is an effort to try to be efficient around this. So adding paperwork about reapplication is not going to be in their interest or yours. So I think if your application is in, it's in the queue, and when they pour more money in these buckets, EIDL and PPP, they'll continue the first come first serve process. Final point on sort of where money is, and this is sort of tangential from your question, Josh, but we heard from one AALU Gamma member just this morning, after the press had reported that they were out of money, that they were approved for their PPP today and should expect a deposit tomorrow or Saturday. So when the government says we've hit the $349 billion limit, because it's a partnership with the private banking institutions, and then ultimately down to the small businesses, it's possible that that just means it's in the throughput process flow. And, I anticipate some people will still get their loans processed in the next days and week. Others will, of course, have to wait until the Congress replenishes the funds, which, as we've said a couple times, they will do. It's a question of when, not if.
So guys,
Yeah, Army,
go ahead, Ken.
no, I'm just going to add one quick comment, which is it's not 100% clear to me that this effort to reload is reloading with respect to EIDL. I think much of the focus is on reloading for the PPP program, and the EIDL was grossly underfunded from the get-go. So I'm a little nervous that we're going to see them do anything on putting more funds into the EIDL just based on the back and forth that's going on right now. We'll have to see. I mean, it's subject to whatever they work out in terms of a deal.
Thanks, Ken. That's very helpful information. So, guys, we are butted up to 3 o'clock here. Want to thank Ken and Army today again, as always, for sharing their expertise and knowledge. We do have a lot of other questions that we will do our best to get through and try to get some information. Best place to find it, as always, we've said this throughout, go to the COVID-19 Action Center at either ALU.org or gammaweb.com. Best place to find updated information on those. We will also be putting this slide deck as well as previous slide decks up there so you guys can access this slide deck and the presentation from today. So thank you very, very much for your time. If you are not a member of ALU or Gamma, we would love to have you and join your voice to our number. So thank you very much for your time, and please let us know if we can continue to help as we go through this. Thank you. Take care.